Interest rates are double what they were a year ago. So how can you get an interest rate that is 3% lower than current rates? We're getting after that right now. Hey everyone, so you're looking to buy a home right now, but these high interest rates are holding you back? Well, I'm covering exactly what you can do to beat those high interest rates so you can get into the home of your dreams with some creative but simple financing options. And just really quick, my name is Xochitl Cervantes with RockStone Real Estate Group here in Austin, Texas. And if you're looking to buy a home and want me to connect you with some lenders, some local lenders that have these amazing programs, well, just give me a call, text me, or email me, and let's chat. All right, so let's get into it. Today, we're going to talk about how to save money when buying a house with something called a buy down. So, when you borrow money from a bank to buy a house, you have to pay back that money with those pesky something called interest. Yes, that's right. So right now, those interest rates are double what they were a year ago, and it's making it super hard to afford your monthly mortgage payments. The good news, though, is that the higher interest rates have driven down home prices. And when we couple this with interest rate buy downs, well, now that home that cost so much more a year ago is now really affordable. A buy down is a special way to make your interest rate lower, at least for a little while. There are different types of buy downs, but we're going to talk about three of the most common ones. The first one is a temporary rate buy down, and is commonly referred to as 3-2-1. In this scenario, typically the seller or builder, if you're buying new construction, will pay the fees associated with the buy down. With this type of buy down, the interest rate is lower by 3% in the first year, 2% in the second one, and 1% in the third year. In years 4 to 30, the loan will be adjusted to whatever the mortgage rate would have been today. This means that your monthly mortgage payment will be lower in the beginning, but they will go up a little bit in the second and third and 4 years, and then remain fixed for the rest of the loan term. The idea is that you can use that time to save some money and then refinance your mortgage later to get a better interest rate. So for example, if the interest rate would have been 6% today with the 3-2-1 program, it would be 3% for the first year, 4% for the second one, 5% for the third year, and then 6% starting in year 4 for the remainder of the loan. Now, everyone's expecting rates to fall over, so it is likely you'll be able to refinance down into a lower long-term interest rate. There are variations of this loan like 2-1 or 3-1 buy downs as well. Now, the good thing about temporary buy downs is that they can make your monthly mortgage payments more affordable, at least in the beginning. But there are also some downsides. For example, if you are planning on living in the house for a long time, a buy down might not be the best idea because your interest rate will go up eventually. The second type of buy down that we're covering today is called a permanent interest rate buy down, which is when the interest rate is lower permanently. So if the interest rate is, say, 6%, you can pay a fee towards your loan and lower your interest rate down to, say, 5%. Costs vary with this, but typically expect to pay about 1% of the home purchase price upfront to get this interest rate buy down. The third way is an adjustable rate mortgage, or an ARM. Now, before you freak out and say, hey, that's what it caused the 2008 crash, let me explain. What happened back then was anyone could get a loan. If you could fuck a mirror, well, you had a loan. Stated income loans were common, where people would say they made a certain amount of money and lenders would just took them at their word and gave them money. And so there we had it. And then the ARMs that were being made at that time had massive balloon payments at the end of the first 3 to 5 years that really smacked everyone. So what you want to look for now is a 5-5-2 ARM, without balloon payments. A 552 arm can give you a rate at 2 to 3% lower than a typical fixed rate mortgage for the first 5 years. At year 5, it will adjust up by a maximum of 2%. So for example, rates are about 6% today. You can get a 4% mortgage for 5 years. At year 5, it will likely adjust to 6%. So over 10 years, you have a blended average of 5% rate. Again, you can refinance into a lower fixed rate, typically after the first 3 years. So for example, on a $600,000 purchase, you will pay about $2,300 in principal and interest for the first 5 years. For years 6 and 10, you will pay just under $2,900 on average. That will be $2,600 over 10 years. So that was a quick rundown of 3 different ways to get an interest rate 3% lower than the market average right now, and how those methods can help you save money when buying a house. Hey, hit me up if you want to learn more about the buy downs so I can connect you with a great lender, and let's get you into your dream home. Let me know what you think about this video in the comments, and if you want to stay up to date on what's happening in the Austin real estate market, well then subscribe to this channel and let's connect, and I'll see you next week.